Mike is dialing in from a different part of the world, but it is a great success case we will talk about and what Mike has built with Etherfi. So we'll talk about the founder story and also the background and what he's built with Etherfi, and also how this topic is entering the space. I'm just waiting for the connection. I really see, very large. Mike, can you hear me?
I can, yeah. Can you hear me okay?
Yes, perfect. So, the topic is the on-chain financial revolution. And we have to dissect it a little bit, what means on-chain and how will we see the future here and how Mike with Etherfi is changing the game. So just a quick background. Mike is the co-founder and CEO of Etherfi, the most decentralized liquid staking protocol on Ethereum. Prior to Etherfi, Mike was founder and CEO of Top Hat, an education technology software company that grew to 500 employees and millions of paying customers. Mike as well is an active angel investor and mentor in the startup community. And Mike, just to set the stage for you, we have a room full of very smart investors, family offices, corporates, financial institutions, and a strong interest to learn about the innovations in the financial industry and how crypto, blockchain, and Web3 will influence this financial sector. So please keep our non-technical audience in mind when you are walking us through the background and the staking and restaking market as well as Etherfi. But let's first start with maybe your founder story. One thing which popped to mind when I first got to know you was, how do you get from an educational company to founding a crypto restaking platform?
Yeah, so maybe I'll start with my journey into crypto, and then that naturally kind of weaves into what became Etherfi. I got into Bitcoin pretty early on. I first bought some Bitcoin back in 2011. I think I first read about it in 2010, which is pretty much at the very kind of beginning of it. And what excited me about it at the time was that it was it was what it is, which is a permissionless monetary system. But in parallel, I was already running Top Hat, which I'd founded out of undergrad university. And so I was kind of preoccupied with that, but have always been sort of paying attention and dabbling with crypto during that time. And so I ran Top Hat for about a decade. It was an education technology company that focused on universities. The basic idea is that we were replacing traditional print textbooks with interactive learning materials, and the business was fairly successful. It scaled to millions of students. We were used by basically all the large universities across North America, and starting to grow in Europe as well. And it was a great learning experience about running a startup in, I would say, on hard mode, in the sense that it was education technology, which is just about the hardest industry you can enter, short of maybe selling to governments. And it was B2B SaaS, which meant that you really had to have a lot of discipline as far as unit economics and just creating a business that was viable. And I think that discipline and experience has been incredibly helpful in when we sold Top Hat in 2021, and I decided to make a pivot to crypto, which I had been doing on the side, and now wanted to turn it more into my full-time occupation. I think it was incredibly helpful to have that discipline and experience, and not, having had a successful exit, not having to worry about a short term, like focusing on anything short term. Like we could focus on something that actually made sense, in 5-10 year time horizons. And I think very few crypto companies, projects operate that way. I think there's a huge amount of short-term thinking in crypto, partly because it is the crypto industry is in most ways, I would say, cursed. Like you could say maybe blessed or cursed with easy access to liquidity and giant decentralized casinos operating kind of in the sky that create opportunities for people to exit early and not have to worry about creating something of lasting value. And I think that leads to so many of the scams and kind of nonsense projects proliferating in crypto. But if you're if like myself, if you're aligned with the ultimate values and mission of crypto, which is democratizing access to financial tools and making it much more transparent and accessible, then crypto is an incredible vehicle to be able to do that. Okay, maybe I'll pause. I'll pause there.
As you also have a background in the financial industry, could you explain to our investors why should we or why should one care about staking at all?
Well, as a staking, and maybe I can give a 15-second introduction to staking, but it is a it's almost like trying to ask like why should you care about the repo markets in treasury bills in the US. In a sense, like you shouldn't. A normal person should never care about these things. This is like in the bowels of the financial system. You really shouldn't need to worry about how that stuff operates. And in the same way, staking is just it's a mechanism. It's part of the Ethereum consensus mechanism that is very important and can serve as the foundation for useful products that normal people should care about. In our case, really almost like a non-custodial banking type solution. So what staking is, as I said, it's part of the Ethereum consensus mechanism. The basic idea of how it works is, the Ethereum network is a decentralized bunch of computers that are running all over the world, trying to maintain a shared state, a shared database. And every time you transact on that network, every time you send tokens from one person to another or execute some piece of code, the entire network needs to agree on the new state of this database. The way they do that is by staking, by depositing a certain amount of the native network token called Ether. So right now, that's about 32 ETH. That's exactly 32 ETH that you need to deposit, which is worth about $100,000. And in exchange for depositing that $100,000, you get the right to run one node on this network. And in exchange for running that node, you get fees from the network. It gives you, a share of the transaction revenue, and it gives you a predictable amount of fees in exchange for running this node. But if you misbehave, if you do something that is malicious on the network, then that $100,000 that you put up can get slashed. You can get penalized. And that's the incentive for everybody to behave. It basically creates a skin in the game type mechanism where everybody who's running a part of this network has a very strong incentive to behave themselves and not try to do anything malicious. That's basically staking. Staking is depositing that $100,000 of ETH in order to either you running that node or delegating that operation of that node to somebody else. And so that's essential. I mean, it's a core part of how the network operates and reaches consensus. It's very important, and it creates, in a sense, a native interest rate for the network, which is the reward rate that staking nodes receive. You can sort of think of it. It's not a great analogy, but it may still be useful. Which is it's sort of like the T-bill rate. The staking rate is sort of like the risk-free interest rate of the network.
Yeah, that's a good comparison. So it's not only investing into the assets like Ethereum, but it's an extra yield also you get by staking those assets, which at the same time also secures the network, right? It gives you certain rights which you then delegate, and you kind of contribute to the security of the overall network as well.
That's right. Yeah, the skin in the game is that security, and that the way the network works is if everybody has a vested interest in making it work, and the native currency of the this global compute network is Ether. That's what gives Ether value. You're getting paid as a percentage yield on that Ether in Ether, as part of participating in the network.
Yeah, you just made a good traditional finance example explaining staking. Is there an example which comes to mind which makes it easy understandable to talk about liquid staking and restaking, which is the topic you are touching upon with EtherFi, so that our audience better understands what EtherFi is about? And how did you come to found?
Yeah, for sure. So yeah, I can. Yeah, I can explain that and then talk about how it led to EtherFi. The the way that staking works, and again, we're talking about something that's very technical, and so in a sense, this stuff shouldn't matter. But right now we're still operating, I guess, at that level. Um, so when you deposit this ETH in order to stake it, in order to get a right to run a part of the network, you have to lock it. You basically deposit it into a safety deposit box, so to speak, and then you can't get it out while it's being staked. Now, that in some cases may be fine if you're comfortable just putting your ETH away and earning this return and not worrying about it. But what if you want to continue to use that asset? So, for example, let's say you want to use it as collateral for a loan, or you want to be able to trade it, or whatever other things that you want to be able to do with it. Well, you need some sort of derivative asset, and that's what liquid staking tokens are. Is you take your ETH, you deposit it in the staking contract. You're now earning a return on that token, and you have a receipt token. In the case of EtherFi, that's called EETH, that you can then use in various DeFi projects. So specifically, you can use it, as I said, to take out loans. You can trade it. You can deposit it. You can loan it to others. You could take leverage on it. You could do all kinds of fun, financial stuff with this token. So that's liquid staking. It's a very natural, kind of obvious thing. It's like if you have a T-bill, you, for example, want to be able to say, yeah, please recognize that I have this T-bill and give me a loan against it. And the bank would likely do that if you're holding it in custody with them. Okay, restaking is another level of abstraction added to this whole system, which is the idea is that you're using your ETH to secure or to get the right to run a part of the Ethereum network. Well, what if you could use that same ETH to secure other networks simultaneously? So in other words, not only are you securing the Ethereum network, but you could be securing another blockchain network or other services that are useful for blockchains, like Oracle networks or off-chain compute services, other cryptoeconomic networks. Now, the question is, why would you want that? Well, because in the same way that you earn rewards by securing the Ethereum network, by creating the skin in the game and running a node on that network, you can do the same thing for other networks. You can secure those networks using your ETH, and that's basically restaking. You're staking it, and then you're restaking it in a bunch of other networks. The reason this makes sense is because the actual risk you take on when you're staking in Ethereum is quite low. I mean, you have a very somewhat predictable reward. And the risk is also predictable and quite low. And you can buy insurance to cover yourself for the risk of staking for a few basis points. So similarly, you can say, well, I mean, that's a pretty low risk. I'm fine taking some additional risk in exchange for a higher reward. So that's what restaking basically lets you do. And similarly, you want to have that same liquid staking token sort of encapsulate that for you, so you can use that position in DeFi. And this is a new category that emerged in really on Ethereum, but more broadly in crypto over the last couple of years, this category of restaking, and has led to a renewed interest in this staking category and kind of explosive growth as a result of it. And that's one of the reasons that if EtherFi that we've been able to scale up to now over 8 billion in assets because we were the first ones to kind of package up this restaking offer and make it really easy and accessible to users.
Okay, yeah, thanks for that. I'm just putting this into perspective for our investors. We've talked a lot about the technology stack within Web3 and also the application and service ecosystem within. And what basically EtherFi is a great innovative new startup which was only possible because Ethereum exists, right? Because a new infrastructure has been set up, because now startups are able to improve even the status quo and to find new business models around which weren't possible before. So for us as a venture capital fund, this is super interesting because as new ecosystems emerge, right, like Ethereum, there's super much innovation which is starting to happen around this, and this offers great investment cases. And these services these startups are offering are enhancing the entire experience of the ecosystem. So I think that's probably the most technical we'll get. I just wanted to make that point that it doesn't always have to be innovation on Web 2 and Web 2 to Web 3, right? But it is also innovation which is happening within this new industry. So maybe let's go back to the big picture. How will widespread adoption of on-chain finance change the way we interact with financial systems and financial applications? What are the main benefits in your opinion?
Well, I mean, I think there's different ways to talk about it. Let me put it this way. If EtherFi was a traditional financial institution at our current scale, and with the current set of products that we offer, we probably would need to have at least 10 times as many employees as we currently do. So right now, EtherFi has about 25 employees. We're generating about $35 million a year in revenue. We'd probably need to have about 200, maybe 250 employees to be able to do the stuff that we do. So that's one way to think about it, that just this framework, this way of operating is just much more efficient and offers lower fees for users. It offers our users access to much more interesting and attractive, I think, opportunities within the crypto world than they would be able to get in the traditional finance world by ETFs or otherwise. Lower fees and more control and more transparency. And so it's just a better product. I mean, I think you really don't need to think about it, the foundations of, crypto and what all the technology is. In the end, the reason I think that traditional finance will eventually replatform onto crypto rails is just because it's much more efficient and it's better for customers, right? That's what drives adoption, not a lot of speculative type stuff. It just needs to be a better product. I think the analogy I like to use, regarding electric cars is that they never took off when it was a worse product, right? When it was the first generation of these electric vehicles with the Prius, which was like a pretty terrible car that you really only cared to own if you were kind of like environmental zealot. Whereas today, electric cars are just objectively better than their internal combustion counterparts, and so the industry is taking off. So in the exact same way, I think crypto will reach mainstream adoption and replatform traditional finance because it's better, and it becomes easier and lower cost for people.
Can you give us an example or a feeling on how large is this market? Where do you see this market going in terms of market size?
Well, I mean, 100x from here, right? Crypto is what is it these days? About 3 trillion market cap or something. So I mean, I think again, I genuinely think eventually all of finance replatforms onto crypto. I mean, to give you an example, so the yield you can get on your savings account in your bank is what, a couple percent these days, and that's what's accessible to you as a normal person, in the US or the EU or whatever. In the crypto world, because there's a lot less friction between allowing users to access, the higher yield opportunities. The yield within I would say as close to risk-free rate as you can get is probably closer to 6 or 7%. And so, I mean, that is like, I mean, you're giving up money by not holding your money on chain. You're not taking any additional risk, any material additional risk, but you're getting a lower, rate of return on your money if you stay in TradFi. And that difference is only going to get amplified as on-ramping onto crypto becomes easier and easier. So that with 2 minutes of effort, somebody will be able to fully re-platform and get a better rate of return, lower fees, and all this great stuff. So how long until that just becomes that trickle of users becomes a fire hose? I mean, I think we're probably a few years away from that happening, and I think EtherFi can be the vehicle for facilitating that.
And what do you think are the main barriers preventing widespread adoption of blockchain-based financial solutions, and what should be built or funded to overcome them?
I mean, a lot of it has to do with regulatory clarity. A lot of it has to do with the fact that it just takes years to get all these licenses to be able to operate, in a legal kind of above board way. We're as EtherFi, like, we're partnered with, and we're in the process of getting a whole string of endless, VASPs and EMIs and MTLs and all kinds of nice, three-letter acronyms for various regulatory licenses we need in order to operate. So that just, I mean, it takes years to do that, just literally years. It's the joke that Elon Musk made about trying to launch rockets in what was it? I think California. He said, "Well, it shouldn't take longer to move papers from one desk to another than it takes to build a giant rocket." But that's the reality of our world. That it shouldn't take longer to move papers from one desk to another than it takes to build an entire financial application. But that's the reality that we live in. But thankfully, like, that glacial pace of change is finally happening, and we're starting to be able to to operate here. I mean, for example, with EtherFi, we're hopefully in a month or two we'll be able to plug into IBANs, where users will be able to wire money in and out directly as if they had a traditional bank account. So it's happening. It just takes its time.
Yeah, then let's look in the future of traditional finance and also on-chain finance. So let's say the year is 2035. In 10 years' time, will on-chain finance replace traditional finance systems, or will they coexist? And what might that coexistence look like, if so?
I mean, I think it depends what you mean by replace. I mean, I think a lot of the financial institutions that exist today will probably continue to exist. I think there certainly will be a consolidation and a whole host of new players that enter the space. Using the analogy of, let's say, newspapers, the early days of the internet, you can see, when advertising revenues really started to kind of fall off a cliff around 2007, 2008, some institutions were able to make the transition and are now bigger than they were ever before, like New York Times and Washington Post, for example, are still pretty large businesses. But a whole set of new businesses emerged that in many ways superseded them. So I think we're going to see the same kind of transition. I mean, I don't know, maybe Europe will be different. Maybe you'll just have the same players kind of sleepwalk their way into the new financial rails. But certainly in the US and maybe other markets, we probably will see a changing of the guard.
And so what are the most exciting innovations enabled by on-chain finance that you find particularly promising in the next 5 to 10 years?
Well, the first and foremost simplest thing is payments. I mean, it may sound silly to say this, 10 years or over 10 years now from the advent of crypto, but I mean, payments still suck, especially cross-border payments. I mean, try to send money to somebody in the U.S. or, God forbid, somewhere in South America or Asia. I mean, in many cases, you just physically cannot do it. The only way to send money is with crypto. So just making that part of people's lives easier and simpler is, I think, a huge step forward. But then as we start seeing more assets get tokenized, we will see the advent of truly programmable finance. Once whether it's government bonds or stocks or other interesting financial assets like real estate start to get tokenized, then it'll really open up the floodgates of capital and make all capital essentially global. So somebody in Nigeria with a smartphone and $20 in their smartphone account will have the same access that a hedge fund manager has today. I think that before you even get to some of the more exotic stuff around AI or agents or other really fun and interesting applications, I think just solving basic payments and financial access is still a major goal.
And if you think of central bank digital currencies, do you think that they will coexist with public blockchain ecosystem, or do they represent competing visions of the future?
I mean, it's a good question. I just don't know that anybody's going to use them. Why? If you think about it's almost like the worst of both worlds, right? It has all the restrictions of traditional fiat, and none of the benefits, but it's also it has the overhead of operating on a crypto, blockchain network. So I'm not saying there may not be some internal use case for them, maybe between or within government agencies, but I just don't. I don't know that they'll get a lot of widespread adoption because I just don't see anybody wanting to use them. If anything, maybe they'll actually accelerate the transition to a crypto rails because people are kind of tired of financial tyranny in general.
Yeah, so as we have a room full of investors, of course, everyone is interested in the next big thing, where to focus on, especially in DeFi, so decentralized finance. So where would you keep an eye on if you were an investor in this space?
I mean, it's very hard to recommend any particular tokens because it's just, the space is so hyper volatile. My personal position is I'm long ETH, and I think that gives me all the, it's almost like an index of decentralized finance. So I think if you're looking to just have some exposure to the space, I would say ETH is a good bet. And I'm much more bullish long-term on ETH than I am, for example, on Bitcoin, because I think a productive asset like ETH is always going to, in the long run, be more valuable than a passive asset. Even if you believe the narrative that Bitcoin is digital gold, like, would you rather hold gold or would you rather hold the NASDAQ? I mean, I probably would rather hold the NASDAQ because those are productive companies that are at the forefront of interesting tech. So, disregarding the price action over the last 6 months, I think is probably wise, and just focus on things that have long-term value. If you want to get into more, picking stocks, so to speak, or picking crypto,
yeah, or verticals.
My personal bias is,
or verticals as
verticals,
well.
Yeah. My personal bias, I mean, in both those cases, is focus on things that actually have long-term cash flows, something that actually generates revenue and has a sustainable economic model. At this point, I think you have to look at individual projects and make the assessment whether they make sense. There's a million things that are going to go, 1,000% in the span of a year because of some narrative, but it's very hard to invest that way. I mean, I even as someone who's kind of an insider, I can't predict which token is going to take off. So what I would do is just bet on projects that actually have cash flows, and you believe will be around in 5 or 10 years.
And a question I also like to ask is more the contrarian view. So, what is your most contrarian take when it comes to the future outlook of on-chain finance or decentralized finance?
Oh, I would say somewhat contrarian is that I'm not that bullish on Bitcoin. I think, aside from being kind of a passive speculative asset, I just, yeah, I mean, I'm much more bullish on things like Ethereum or, to a lesser extent Solana. But I think those are the ecosystems I'm more excited about. Um, there's so much hype in the space. I would say just don't touch projects that have been around less than a year or two. Maybe that's another, I don't know if that's contrarian or not, because there's so many things that are going to have, like, if you look at a lot of crypto projects, what you find is the same graph over and over again. They sort of spike up and then they're down only for 4 or 5 years. So my advice is just try to focus on things that have been around and have some longevity to them.
On that point, the typical graph you would see, do you think this is because projects also go live too early before they have product market fit, because there's just no traction, or why would you say, or how do you see this
I think that's a big part of it, for sure. Yeah, 100%. I mean, the early liquidity in crypto is a curse. It really crowds out productive use of capital and instead just focuses on one narrative after another. So that's part of it. I mean, and generally, projects tend to get hyped up early on, and there's kind of a rotation that happens from the early investors to more retail. But we're starting to see. I mean, to give examples of other projects, like let's say Aave or a handful of others like Uniswap, where they're almost back to their all-time highs from when they were much smaller and were much more in the hype cycle. But now I would say the valuations are much more fundamentals driven. So I think long-term thinking generally always tends to win.
We also have a few founders in the room from our portfolio. Some are more progressed, some have started up. So if you look at your learnings as a founder, and you've been around this space also for a long time, what would be your advice, and kind of what learnings have you reflected on?
For founders, I mean, one of the most there's so many things that could be said. One of the most important things I would say that any founder needs to focus on is the quality of their team. So the almost cliche at this point is hire slow but fire fast. So get very good at hiring and making sure that you bring on high quality people onto your team, and if don't hesitate to move out people that are not performing. That's probably the most important thing. If you have the right team in a good market, then eventually everything else kind of sorts itself out. Whereas if you don't have the right team, there's almost nothing that you can do to fix that.
And what would you say is the most important thing, if you were an investor, to watch out for in picking founders?
Picking founders. I mean, really the only thing that you can look at is track record. If you're looking at a team that, for example, they've been around for 4 years and they still haven't shipped a product, that tends to be a really almost common pattern in crypto, is teams that just kind of stick around for years and years. So that's a huge red flag. I would say you want to look for people that have a track record of success, whether it's in prior projects or generally, because people that are successful tend to continue to be successful.
Perfect. So we're coming to an end. Maybe as a summary question, maybe you can summarize for the audience kind of your take on advantages, decentralized finance versus centralized finance, and also to end our session, what would you want the audience to take away from this panel?
So, I mean, I guess not to sound like too much of a broken record, but I mean, in the end, the reason decentralized finance is going to win and re-platform finance is because it's cheaper, it's more efficient, it's more transparent. In the end, it's safer for users, and it'll just be a better product. So that's why it's going to win. As far as investing, I mean, if you want to be passive about it, as I said, the easiest thing to do is just buy ETH and close your eyes for a decade. That's probably the safest bet that you can make. And if you if you want to stake it, then come to EtherFi. But if you want to try and get more risk, you more be more risk on, then what I would say is you almost need to establish some expertise in this category within your fund or your family office. You need to have one or two people that are full time looking at this space in the same way that you might have people that are analysts looking at different public market equities, or private placements or whatever. It requires work. You have to focus on it. And I would say, ignoring you would ignore crypto at your peril. You're not going to perform as well as funds that are part of the forefront. It's almost like ignoring the Nasdaq, starting in the 70s, or whenever things really started turning. I mean, you would have missed out on probably some of the highest returning assets in all of finance. So I would say you just need to do the work and start actually focusing on this category.
Perfect. Well, thanks so much.